Hello everyone, welcome to the Brainless Investor YouTube channel. Today we will be discussing what's a bond, how do bonds work, determining bonds coupon rates, what are the categories of bonds, and what are the variations of bonds. So first of all, let's understand what's a bond. A bond is a type of loan, but instead of bank lending money to a borrower, it's investor lending money to an organizations, such as government, cities, or corporations. Not every bond can be traded without difficulty, and certain securities are not accessible to individual investors. When interest rate goes up, bond prices goes down, and when interest rate goes down, bond prices goes up. In addition to purchasing individual bond, investor can invest in a variety of bond portfolio through funds, including bond exchange traded funds (ETF). Many bonds provide consistent and steady interest payment, making them ideal for individuals relying on a fixed income. Now you know what's a bond, so how do they work? So first of all, you need an issuer. The organization that needs to raise money issues a bond. Common issuers includes government like US Treasury bonds or companies' corporate bonds. Second, you need investors or known as buyers. People or institutions buy the bonds, essentially lending money to the issuers. Face value or par value. The amount of bond is worth at maturity, usually 1,000 US dollars. This is what the issuer repays at the end. The fourth one is coupon. The interest paid to the bondholder, usually annually or semi-annually. For example, a 5% annual coupon on a $1,000 bond means you get $50 per year. And then the fifth one is maturity date, the date when the issuer repays the full face value of the bond to the investor. Now, let's move on to how do we determine bonds coupon rates. Two main characteristics of a bond that primarily influence its coupon rate: creditworthiness and time until maturity. When the issuer has a low credit rating, there is a higher chance of default, which is known as bankruptcy, which leads to these bonds offering increased interest payments. Additionally, bonds with longer maturity periods typically provide a greater interest rate. This additional return is due to the bondholder facing greater risk related to interest rates and inflation over a longer time frame. Moving on, let's look at the four categories of bond. The first one is corporate bonds. Instead of opting for bank loans to finance their debts, companies choose to issue corporate bonds because the bond market provides better conditions and lower interest rates. The second one is municipal bonds. These bonds are created by states and local government. Certain municipal bonds provide investors with coupon income that is exempt from taxes. The third one is government bonds. The U.S. Treasury categorizes bonds based on their maturity periods. Those with 1 year or less are known as bills. Those with 1 to 10 years is known as notes, and those with more than 10 years as bonds. Collectively, all bonds issued by the government treasury are commonly called treasuries. The fourth one is agency bonds. These bonds are issued by organizations connected to the government like Fannie Mae or Freddie Mac, are classified as agency bonds. Next, let's understand the four variations of bonds. The first one is zero coupon bonds, or known as Z bonds. These bonds do not provide periodic interest payment. Instead, they are issued at a lower price compared to their overall value, allowing bondholders to receive their full amount upon maturity, resulting in a return. U.S. Treasury bills falls into the category of zero coupon bonds. Next is callable bond. These bonds also features an option, but it differs from that of a convertible bonds. Callable bond can be redeemed by issuing company prior to its maturity date. These type of bonds poses greater risk to investors since it is more likely to be redeemed when its values increase. Let's move on to the third variation of bonds, which is convertible bonds. These are debt securities that come with an option for bondholders to exchange their bonds for shares of stock, contingent upon specific criteria such as the stock price. The fourth one is puttable bonds. These bonds provide bondholder with the right to sell them back to the issuers before they reach maturity date. These features is advantage for investor concerned about potential decline in bond value. Those anticipating rising interest rate who prefer to recoup their investment before experiencing a loss. Typically, a puttable bond is valued higher than a similar bond without a put option, given that both have the same credit rating, maturity, and interest rate due to its increased worth for investors. Before we end this video, let's look at an example of government bonds. Imagine the US government wants to raise money to build infrastructures. They issue a 10-year bond with the following terms. Face value, or known as principal, 1,000 US dollars. Coupon rate is 5% annually. Maturity date is 10 years. So what happens next? You'll pay the $1,000 to buy the bond. Every year you receive 50 in interest, which is 5% of $1,000. This continues for 10 years, totaling 500 in interest rate. At the end of the 10th year, the government returns your $1,000. Your total return is 500 in interest over 10 years, plus your 1,000 principal returned, total of $1,500. We hope you understand what's a bond after watching this video. If you liked it, please leave a thumbs up and subscribe to our YouTube channel.